final real option that we're going to talk about is the option to abandon an unprofitable project. Okay? Sometimes closing a project, abandoning a project is the right thing to do. Okay? Of course, all projects have to be constantly evaluated, right? You know, once you decide to invest in a drug, for example, to invest in R&D, to buy a machine, to open a division, you know, any corporate decision has to be constantly evaluated. In fact, one of the topics we're going to talk about in Module 4 is how to evaluate ongoing projects and divisions. That's one of our topics, okay? For now, let's talk about this, the value of this option to abandon, right? So the idea is that, you know, you can exercise this option, you can use this option by shutting down a project that has become negative NPV, okay? The other way that companies can exercise this option, of course, is by selling projects, right? Perhaps the project is not as valuable to you as it is to a competitor, so it may be worthwhile to abandon this project, move on, sell it to someone else, you know, try to make some cash, and go do something else. So shutting down projects in many cases is the right thing to do, okay? Let's talk about this option in the context of our example, the gold mine, right? We assumed in the beginning that the gold mine was irreversible, so you could not close the mine once it's open. That is likely to be a little bit not realistic assumption, you know, unless the government forces you to keep the mine, right? You probably have a license from the government might force you to extract gold anyway, but if that's not the case, the company is very likely to be able to close the mine by paying a closing cost. We call that a decommissioning cost. Okay, those are synonyms. You could think about the decommissioning cost as a closing cost. Okay, so let's say in our example there is a closing cost of $5,000. Okay, so that's not a huge cost. How would that change your analysis, right? Now we have to consider the option of opening today, right? And then closing tomorrow if the gold price goes down. Remember, the main benefit of waiting was that we could wait until tomorrow and avoid opening the mine if the gold price went down. Now we have a third option, which is to open today, make the profit, pocket the money, but then close tomorrow if the gold price goes down, okay? So I've made the profit tree for you in this case, okay? So now what we have the profit here at the beginning, right? And this is the important change. If the gold price goes down and the mine becomes unprofitable, you can close it by paying $5,000, okay? You pay $5,000 and you close the mine, and then of course the mine remains closed until the end. You just make a zero profit, okay? If the gold price goes up, of course, you're going to keep the mine open and make the profits, right? It's not worth closing the mine in that case. So that is the tree that corresponds to this third option. And notice that the $5,000 here is precisely the decommissioning cost, okay? So now the question for you. Previously, in the previous question, you worked out the decision tree. Now, I've done the decision tree for you. Try to use the decision tree to compute the NPV. Okay, so let's check your answer, right? Let's see if you've done the right calculation here, right? So what we have the NPV, right, is going to be equal to minus 70, right, because you open at time 0, plus the date 0 profit, right? So let's mark the numbers when we take them into account, right? And then here, next year, we have a 50% chance of a profit of 90, right? We have to discount that, okay, by 5%, okay? And then, right, there is a 50% chance of a loss. The loss now is only $5,000 times the minus 5, okay? Again, we're going to discount that one period, okay? There is nothing here. If you close the mine, there is 0. So the only numbers we need to consider are the numbers there. So it's 25 times 140, right? Divided by 1 plus 5% to the second, okay? Plus 25% times 40. Okay, so we are taking this number into account, Okay? So here's the entire calculation done for you. Remember, here we have to discount by 2 periods as well, right? Because we are 2 periods ahead. So that's how the NPV would look like, okay? If you do this calculation, you should have obtained an NPV of 51,292, okay? So that's the NPV of opening now and closing tomorrow if the gold price goes down, right? So now we have 3 NPVs, right? If you open now and keep it open, it's 44. If you don't open now and wait, it's 53,340, right? If you open now and close tomorrow, it's 51,292. So now the optimal decision is to open today and exercise the option to abandon. So in this case, the option to abandon, to close the mine, becomes very valuable, right? It actually makes it more likely you're going to start the mine today. Okay? An important observation here is the notion of irreversibility, right? We can capture the notion of irreversibility with this decommissioning cost, okay? If the cost of closing the mine was very high, then it would obviously not make sense to open today and close tomorrow, right? In the first example that we gave, we assumed that this cost was infinite, so you could never close the mine, and then we worked with a cost of 5K, okay? So of course, the cost could be, at any specific value, right? The notion that is important to realize is that this cost is what's going to capture reversibility for us. Investments that have high shutdown costs are going to be irreversible, right? And those are going to be the investments for which the option to wait is the most valuable, right? Because if an investment is irreversible, it really makes sense to wait until you're sure that this investment is going to be positive NPV. If the investment is not irreversible, then you might as well start today and close it tomorrow if things turn out to be bad. Okay? So let's give a few examples of irreversible investments. For example, building a factory may be an irreversible investment, right? Once you have put all the equipment in place, it may be very difficult to close the factory. There are lots of fixed costs, so you may end up having to operate a factory even if your sales turns out to be worse than expected, for example. Okay? Or testing a drug on thousands of patients, which is the example we just talked about for R&D. Once you've done that testing, it's gone, right? You can't go back and recover that money. That's completely irreversible, right? So drug companies have to really think about whether it makes sense to continue doing research or not, because those are definitely reversible investments.